I always wanted to be in the business. And it was interesting because in 1987, coming out of a great bull market run, everyone was making money. It was really hard to get into. The people around us were having, oh shit moments like, oh, so it was a very interesting way to get acclimated to this industry. These are the people that need to learn early on how this industry works, what you should do, how you should invest. And that's what we're trying to help a lot of people do, for sure. They all saw The Wolf of Wall Street and they're like, Dad, you got to see The Wolf of Wall Street. And I'm like, Dad, I live The Wolf of Wall Street. I mean, we were there.
Hello, welcome back to the Raz Report. I'm excited to have on John Nowicki, owner, founder of LCM Capital Management. Welcome to the Raz Report, John.
Jason, thank you very much. Happy to be here. Look forward to today.
Yes, we're looking forward to having you. And listen, we have casual conversations from people who are in the markets to entrepreneurs to analysts like Kathy Wood. It runs the gamut to Mark Cuban. And like the reason I like to interview all types of people and what you guys do is because every day all of us go in to the office or go somewhere or stay home, and these days, and we do an occupation. We either help people manage money, grow, create a product. Now, from what I understand is you help people manage money.
That is correct.
Okay. How long?
Okay,
so how long have you been doing that for?
Since 1987, Jason. That's when I was first
Whoa,
licensed.
You started at a weird time, sir.
A month right before the crash. But I like to tell everyone we had no clients invested in the market. And that's only because I didn't have any at the time. So it's actually
good. That was good. That was good. You were extra erudite or prescient with your yes. There you go. So when you got into the markets in '87, prior to that, John, I guess will you just tell us a little bit of your background before you even got into the markets in '87? Just a little bit, whatever you think could be helpful to the audience.
Sure. So you mentioned Mark Cuban. I am also an IU grad.
Oh, nice.
Yes. And that's where I met my lovely wife, actually, of 37 years. But I always wanted to be in the business. And it was interesting because in 1987, coming out of a great bull market run, everyone was making money. It was really hard to get into. So I went, interviewed at the bigger houses. No one was hiring. Ended up at a small little place that would let me get my license. And that's how I really started. So this is the only business I have known my entire working career.
Wow. Okay. So you got in early. You in '87 was probably not the best time. So what I actually wondered during that crash time and the markets being down, were there days you're like, on this podcast, you can swear, but I'll just go, were there days like, what the F am I doing in this industry? Like, I just can't imagine, because in '87 I was 9 years old. So, like, what was it like for you? And like, if you can circle back to that.
Sure, absolutely. It was interesting because the place I was at had one Quotron machine.
Yes, I know what those are.
Back in the day, you had to keep hitting enter to get an update refresh screen, and there were 10 of us sitting in front of this machine watching. And again, as I mentioned, having no clients involved. This was kind of an awesome experience, except that the people around us were having, oh shit moments like, oh, so it was a very interesting way to get acclimated to this industry. But the timing of it worked out pretty well, right? Because the market pretty much was wiped out, for lack of a better word, in a very short period of time. So for someone as a newbie as myself to come in here and start, prospecting and going after clients, it was very easy to say to them, hey, I had nobody invested in the market because obviously, as I mentioned before, didn't have any clients in it. So It was a great time to start. So it was a very interesting time for sure, to say the least, but one that I will obviously never forget.
Well, what's really interesting you say that. So there's a community bank getting started here in Michigan, in Birmingham, Michigan, and they're raising money. And the point that they're making is that they're in a better position than these other banks because they don't have these legacy loans that are at lower rates than what they're at today. And it's actually a very good point. So when you started in '87, you didn't have people that blew out their whole account, and which is very interesting. So given that background, '87 you're around for, then you start growing, then you come to this era of like '98, the dot-com era.
Yep.
Tell me what it was like then, okay? The
Yeah,
good, the bad, and the
absolutely.
ugly.
So it was interesting. So, my partner and I, Gary Wozni, we kind of continued to grow our business. And like a lot of people back in that day, we were at different firms. And we ran some different operations, opened an office here in Chicago. So we kind of kept moving upscale, bigger and bigger as firms. But what we realized, Jason, was at the end of the day, and look at, I mean, you know, you're not, my industry, I'm a total skeptic on, right? I mean, analysts, strategists, I mean, all of these people, in my opinion, are worthless. They know nothing more than you or I. And all you have to do is look at the industry today to see companies downgrading or upgrading companies, and removing them from their buy list after they've dropped 40%. So no one knows what happens. But I, being naive and growing a business, we kept listening to these people thinking, oh, this is great, this is great. So finally in 1998, my partner and I said, look, this is what we got to do. If we're going to do this right, let's start a investment advisory firm. So we went to a company that was primarily doing raising money for the dot-com boom. Right? This is when everyone was throwing money at companies and all these great ideas. And they never had an investment advisory component to it. And the individual that owned the company said to himself, look, if people are signing on the bottom line and they're signing off and saying, here's $100,000, I don't care if I lose it, it means nothing to me. He went after the sticky money. So the sticky money was us, right? So that's the more conservative based, Microsofts of the world, if you will, stocks and bonds. So we started doing that, and we grew from zero to $40 million in 6 months. Then what happened is a company came in to buy the company. And we looked around, and what this company wanted to do was blow up our entire model of what we were about and what we wanted to do. And so my partner looked at each other. We didn't own any of this company, so we had no say in it. So we looked at each other and said, that's it, we're done. The only way we're going to do this is if we do it ourselves and we start from zero. And so it's known, we went cold turkey. So we went from transaction-orientated business to fee-based business in 2000 after, again, the market blew up and we're sitting wondering from these analysts, well, wait a minute, you just told us Yahoo was worth more money than Disney and we should be buying it. And now you're telling me, oh, that was wrong, let's go on to the next one. Well, it's easy for them to say because they don't have to talk to a client to say, Mrs. Smith, sorry, your $50,000 is worth $5 today. And so my partner and I said, look, the only way we're going to do this and do it right is if we start our own company. And that's exactly what we did.
And so what year was that when you started?
That was 2000. That was
wow. You have interesting starting times. 2000, 87.
I can assure I'm starting no more after.
Yes. Okay, so now you been in that business now since 2000, the one you're in now?
Yep, LCM Capital Management. My partner and I started it and founded it, and what it stands for is low cost management, not Larry, Curly, and Moe. And the
reality, that's when you LCM. I was like, Yes,
yeah. No Shemp. No, the Shemp's not involved into this. So that's what we did, and we've been doing it ever since. And as I mentioned, we went cold turkey, and I've got 4 kids. We have 4 children, and making that decision was brutal from a financial perspective, because literally I have that first deposit slip that we had at LCM Capital Management, and it was $1,085. That's what we deposited. So I had a house, took out a second mortgage, have 4 young kids. My wife is going to school to get her MBA, and doing it this way, we knew was the right thing to do, but financial strain. So there's a couple of things about me. So, and I tell people this story, Jason, and I may cry, which I apologize if I do, but I remember going to our bank for a 3rd line of credit, and my banker told me, Johnny, there's nothing left. I can't do it. And I will never forget that day. The second thing was, we were up in Michigan at a friend's cottage, and I went to buy a squirt gun for our friend's son, whose birthday it was. And the squirt gun was $19.99. And I went with a credit card at Walmart, and it didn't go through. I tried it again, and I didn't go through. And I told the lady, just try it again, if you will. So the line starts building up behind me, and I'm starting to panic. And I get the credit card company on the phone, and they say, we haven't received a payment from you in over a month. Your credit card's overextended. And the first thing I thought of, Jason, was, holy shit, do I have cash to get gas to get my family back home? I will never, ever forget those two experiences. But I knew that if we wouldn't have gone fee-based, it would have been very easy to say, oh, let's make a couple transactions, do some revenue, and take the edge off. It's not the right thing to do. So we did it this way, and I'm happy to say that we survived and have come out on the other side. We've got $400 million worth of client assets. My partner and I, we like to tell people we're two hardworking Polacks. We don't come from, a financial background that our parents have helped us. What they've grained in us is work hard, and that's what we do. So that brings us up to today.
Wait, so let's go back to a couple of things. So you're at the Walmart, the credit cards bounce, your cash, you don't know if you can get home. You go to your friend's house. Do you end up getting the squirt gun?
No, I couldn't get it.
And then you come. Do you tell your wife what happened?
Oh yeah, absolutely.
And was that hard for you to tell your wife because you feel like you're not like living up to whatever?
Absolutely. There's no question about it. And God love my wife. Always the optimistic. We're going to be fine. It's going to be fine. I'll go back to work. I'll drop out of school. I'll do whatever it takes. So, it's always good to have a good partner. I apologize for getting emotional, but
no,
I will never, ever forget it. A bad feeling. And but the great thing about that experience, though, Jason, is when we're sitting down with people and helping them, I can relate to people's financial situation, right? I have been there. I know. Right?
You've been in their shoes.
Absolutely.
It's not just about getting, and that's what it's about. To me, if you're going to use a financial advisor or, a firm, talking to people that can resonate and relate to you, because what I think, and where I was going with my questions about like year 2000 stuff, I think at some points in life here, we're always like, the neighbor next door, I want to make more money than them. I want to make more money than them. But then what happens is when the market declines and now you don't want to lose as much. You want to save it. And then at the end of the day, you want to be able to sleep at night. And it doesn't mean that you need to be rich and, never throw out money. But what it does mean is that you can sleep at night. So, given was part of it before you started your business in 2000? Well, you had 4 kids. So that's expensive. I was wondering if you get like
3 in college at one time too. Again, 3 at one time. And I wouldn't wish that on my worst enemy. Again, bringing it back to real life, client discussions. I've been there. It was a lot of money. And so we're not calling our clients from my yacht, right? Saying, here's what you should do,
Right. So will you describe what a fee-based advisor is? Like you switched to fee versus you could have just taken some quick money and got some commissions. Yeah. Can you describe what that means? I know it's pretty basic for you.
Yeah, absolutely. So, it literally in its most basic sense is we charge a fee, an annual management fee on the amount of assets that we manage. So, it's really it. And the difference with us too is that our industry loves to nickel and dime people to death, Jason. So we don't charge for transaction costs. I don't want to start throwing out words of that our industry likes to do, but you pay us a fee, and when we're buying and selling for you, you don't get an additional bill for $10 or $5 or $8 for that transaction. You just get a monthly bill from us that's deducted from your account, and that is what a fee-based account is. And the great thing about it is, from my perspective, is we've had clients since 2000, right? They've owned Apple, they've owned Microsoft since these times. The amount of embedded gains are massive, and I can assure you, if you were in a transaction-orientated business, you'd be a little tempted to say, let's get out of this, and let's make this and buy this and sell this, because look I did back in the day. It's funny. Our 3 oldest are sons, and they all saw The Wolf of Wall Street. And I don't know if you saw that movie, and they're like, Dad, you got to see The Wolf of Wall Street. And I'm like, Dad, I live The Wolf of Wall Street. We were there. I was in it. It was exactly our lifestyle. It was a lot of fun. It was crazy. Unbelievable, frightening stories. But at the end of the day, fee base is completely different than that, and it's the right way to do it too. So for sure.
Got it. So by the way, like, is that how it should have always been? Like doing it structured like that?
Absolutely.
Like, is that you know what I mean? Like, is that because your interests are aligned, right? And like, it's it's one thing because if you're not that way, then when you give me advice to go buy a municipal, what are you making in the back end, right?
Yeah, absolutely. And it's a great point because, there are a lot of people in my industry are duly licensed, right? They've got both a brokerage license and advisory license. I think that's the largest conflict of interest that can possibly exist because when are you wearing what hat and why are you looking after me, now, or you're not looking after me. Yep. So yeah, I completely agree with you. The reason why that, it never was, our industry really wasn't that way is because there's no money involved in it, right? I mean, back in the day, right? Okay. You could charge 2 or 3% on a transaction in and a transaction out, right? So one of the great things about technology is it kind of started squeezing the margins, so to speak. And look, my industry is built on generating fees and revenues, and there's a lot of money, which is why they keep creating all these products and doing all of these things, for the betterment of the investors. But it's not the betterment of the investors; it's for the betterment of the firm. It's the firm first, and if the client should make money later, then that's great. But, you mentioned the banks in Birmingham. I mean, Silicon Valley Bank. I mean, you start looking at this stuff. I mean, Mark Cuban, perfect example, right? He had a ton of money in that bank. He's protected. Mark Cuban's a smart guy. He knows the SIPC insurance limits. What the hell's he doing with more than $5 million in the bank? He's going to get taken care of. But my assets are going to be frozen because I have 300,000. I mean, it's again, we created our company for everybody. But our clientele, I mean, look, we have our wealthiest clients, a $200 million net worth client. Our largest client's a $45 million account. But we have kids that are my daughters, my friends that are $1,000. These are the people that need to learn early on how this industry works, what you should do, how you should invest, what you should control, what you can control. And that's what we're trying to help a lot of people do for sure.
Got it. And the ones that are the small accounts, do you do like a robo type thing or how?
Yeah.
Okay.
No, great question. We use ETFs, right? So exchange traded funds. So we hate mutual funds, Jason. In 1998, we wrote an article called The Great American Ripoff, and it's still applicable today. We just adjust and update the numbers accordingly because there are fees on top of fees, right? I mean, my industry, what they love to do is charge a fee, right? They charge 1% management fee, a fee-based account, and then they invest their clients' money in mutual funds. Well, those funds have fees. And then that expense ratio. And then on top of that, those mutual funds have trading costs, right? And they have other tax ramifications. So those fees are on top of fees. And these funds now are owning mutual funds inside of those funds, which are just more funds and more fees, right? So when people invest, they think they're paying 1% a year. And we love to ask the question, what does it cost you to have your money run? And everyone says 1%. And then we get their statements and we run through their account and say, well, you have 45 mutual funds here and the average one has at least a 1% expense ratio. So now you're minimally at 2. So it's not costing you 1, it's costing you 2, right? So ETFs have an expense ratio for sure, but they're low, right? I mean, there's 6 basis points, 8 basis points. So the great thing about the ETFs is it allows for instant diversification. So we can buy the indexes, which we do for everybody, whether you have $10 million with us or 1,000, you own the same ETFs, right? And so the great thing about that is it gives you instant diversification for the lower end client, and it gives you liquidity. You can buy and sell it if you need it intraday. Where a mutual fund, right? You've got to put an order in, you got to wait to the end of the day to buy it, or you got to wait to the end of the day to sell it. So again, another reason why we just hate funds and use ETFs. And for our perspective, you got to have at least $100,000 for us to start buying individual stocks because we really can't, to your point earlier about diversification, we want to be able to have them diversified. But we will. We're an asset allocator, right? So we're all stock to bond for everybody. And even if you have $10,000 with us, Jason, you're going to own an individual bond or a CD. We're not going to buy a bond fund because, again, we hate these things, the leverage that's involved in these things.
Wait, hold on. Yeah. Why are you not going to buy a bond fund?
Well, just for that reason, that you've got no maturity, right? A bond fund never matures. You've got leverage that can be used inside of those bond funds as well. You've got the tax ramifications. You have the additional cost ramifications. So as a test, as a perfect test, even in the ETF world, I bought for myself, and I'm assuming if we need to change this, we can change this, the short-term ETF. And SPY, not SPY. I'm trying to remember the symbol of it. Shoot, I wish I remember the symbol. But I did it. The short-term Treasury. I did it for myself as a test to see what's going to happen. I'm 10 months into it, and this thing is still paying me 2%, and yet short-term Treasuries are 5%. Right? That's 300 basis point difference. So if we're buying a CD for a client, we're buying it and locking it in a rate of return of X%. You're not getting that fluctuation. If rates go up, that bond fund is going to get smoked as they did in 2022, right? Yes, the bonds that we own and own for our clients, they went down, but guess what? They're going to go back to par and mature, right? That bond fund doesn't.
Yep. So I asked because when Benzinga, we did a private equity transaction in 2021 where we sold a big piece of the company, and I had some cash, and it was when interest rates were 0%. And I have this firm, it's one of those big banks, and I said, can I just get like 0.5% or something? 0.5, not 1%, not 2%, not like, they're paying 5. So they're like, this bond fund gives 0.72. Okay. This was money I didn't want to risk. I was just like, it was a decent amount of cash, and well, yeah, that thing went literally straight down. Like I was like shocked by it because I was shocked, and it's still down now. It's because of the yield, and so yeah, now I have T-bills and municipals and all that. But that bond fund, I would never, like what you said just now, and that's why I ring. I would never invest in a bond fund ever again. I still can't believe they put me in this bond fund because the bonds don't mature. I'm stuck in it. I'm down. The numbers are large or relatively large, I guess, and yeah, that's okay. I don't know why they put me in a bond fund. So why do they even? So then answer this question: why do they create these bond funds? Like what? Like what's the? Give me the opposite side. Like why should Joe Blow invest in a bond fund, or should they not?
They should not. I mean, look at why does Vegas keep building bigger hotels?
Right.
Not like money's taken. I mean, all these products, Jason, are built for the house. The house is always going to win and always going to take their money first, right? But the sale to 99.99% of investors are financially illiterate. We tell everyone this, right? I mean, no one's ever taught this, and it should be a prerequisite for college, in my opinion. You can't graduate without getting investing 101. Everyone knows about compounding and things of that, but no one has ever taught this stuff. Now, I'm lucky having done this my whole life, so my kids are well versed in the world of finance and what it needs to happen. But again, at the end of the day, these things are created to be sold. I mean, sold to clients. I mean, you look at what happened in the gold boom, right? I don't know if your wife, I know my wife was invited to all these gold parties. Bring your gold. We'll give you money for it.
Yeah.
My numbers are going to be off. But at the time, there was 24 gold funds. By the end of that quarter, there were 345 gold funds, right? Why? Everyone's buying gold. Get a gold fund out the door. Get it into your clients so we can make money. Well, what happened to gold? Whoop! And it's like, oh, shit, that didn't work. So let's create something else. I mean, this is what my industry does. And I can say this because I've been in it since 1987. And so I see it, and we continue to see it, and it doesn't stop. But it's because people are uneducated and they don't know what to ask, right? Every industry hates an educated consumer, right? Because then you start asking questions. My industry, whoo, when we're prospecting people, we go back to your person, ask them the following questions, see what the answer is. We literally got a response from somebody who said, I still haven't heard the answer to the question. I mean, he was going to get back to me, she said. What do you mean? That's not the answer. It's an unbelievable industry.
Okay, okay, now we're gonna switch to something. How often do you communicate to clients? Is it just like random? Is there a set standard, or is it like some people don't want to hear from you unless they want to hear from you?
Yeah, I mean that's so we, as I mentioned, we're asset allocators, right? So we manage our clients' money to their risk tolerance, and you reference this sleeping at night, right? If you're lying awake in bed and you're worried about losing money, you're taking too much risk. So in 2008, in 2022, our clients aren't calling us. The only person that calls me is my father-in-law, right? He's like, John, did you see what happened today? I'm like, Papa, what happened today? He's like, oh my God, who's watching my money? I'm like, I know what happened today, Papa, but no one, I mean, it doesn't matter what happened today, right? I mean, the markets go up over time. And so if you're allocated and you're invested to your risk tolerance, you're not worried at all about how much money you may or may not be losing. So every quarter, we send out a report for clients and we give them a snapshot. We have some clients, Jason, that want to talk to us pretty regularly. When I say that, it's every month. And we have clients that don't want to talk to us at all. They're like, I watch, I read what you send to me. I know how I'm allocated. I know what I'm invested in. I know what I'm paying. Mm-hmm. I'm good. So it's a godsend, right? Because honestly, from our perspective, I don't want to be holding everyone's hand. But what we pride ourselves in doing is educating them, explaining to them what we do. And in the beginning, we're having a lot of conversations with clients. And then once they understand what's going on and what we own, they get it. And it's awesome.
No, and that makes your life easier. So let's say someone has $1 million, okay? Yep. And $1 million, well, $1 million, let's say it's $1 million cash, but they don't have it invested or anything. How do you do that, like portfolio strategy of where like 60-40 bonds, stocks, or what would you broadly suggest? Okay, you probably need another age. Let's say they're 45.
Yep. No, I'm glad you asked the age because we're agnostic to age, right? We've got an 80-year-old client who drives a motorcycle. This guy wants to go 100 miles an hour and he's aggressive. Our only joke is just let me know when you're out on the road so I'm not on the road. But he wants to go 100 miles an hour, right?
Tell him to chill.
Exactly. But conversely, we have children of clients who are 25 and the book says, be really aggressive. These are the most conservative kids I've ever met. And they don't want to lose any money. So who am I to say, oh, don't worry about it, right? Just take it easy. Don't watch baloney. They're going to watch because they're conservative. So that's where the risk tolerance comes in. So we figure out how much, we work with a lot of doctor groups and we work with a lot of surgery centers. And I love them as clients because of the fact that, our analogy for the surgery centers is everyone comes out of surgery and you don't give them the same amount of morphine or painkillers, right? Everyone's got a different tolerance of pain. No different in investing. Tell us what your tolerance of pain is. And we're going to manage that money to that pain. So this person with $1 million comes in and says, I don't want to, I want no pain. Then you're going to be conservative. Or I want a little bit of pain. Then you're going to be moderate conservative. And for us, that's going to be 30 or 40% equities and 60, 70% fixed income. And it's all going to be individual stocks and it's all going to be individual bonds because at the end of the day, fees, inflation, and in taxes, those three things affect every investment in the world. And the only one that's uncontrollable is inflation, as everyone's experience. Fees, you got to pay them, right? If anyone tells you they're free, run for the hills. So keep that low and know what it is. And taxes, you have to pay them. But guess what? If you can control them, something you can't do in a mutual fund, and if you can defer them, you can't do that in a mutual fund, and put those two savings, fees and taxes, back into your account over 20, 30, 40 years, Jason, it is a gobs of money that you never knew existed because the house is keeping it. And that's what we focus on. And seriously, I mean, it's 100 or 200 basis points a year. And $1 million at 5% a year for 30 years, you're talking millions of dollars for doing nothing, right? But controlling their taxes and cutting their fees.
Just by delay, okay. And then, and that's crazy. And then you said one of your biggest clients is 45 million.
Yep.
Do you suggest different things for them? Like, is it like buy-in preferreds or this? Like, how do you?
No, not at all. Everybody is the same. I mean, everyone owns Microsoft. Everyone owns, Apple. I mean, no, we treat that person has ETFs. right? They've got the same ETFs that everyone else has. We treat nobody different. The only way we treat people differently is A, from a risk perspective, and then B, if from a cash flow perspective, because look, clearly there are people who are living on these investments or off of these investments, and they only want tax-free income, right, or something of that nature. So there obviously is some tweaking that gets involved, but at the end of the day, that person just owns more Microsoft than the person with $500,000.
Got it. Okay, so it might be tweaking percentage, but they're going to own more Microsoft. Now, if you have a person that comes to you and says, "Okay, listen, John, I run or really sleep at night. I don't want to. If the market goes down 10%, I don't want to give a shit." Do you? I guess my question is, do you have anyone that comes to you and says, "John, I just don't want to be exposed to much things, so much risk." So would you do like a 90% do you ever do that?
Well, we 100%. I mean, we don't have 100% equity. There's not anybody that's 100% equity. So, it's 90-10 at the highest on that side. On the other side, we have clients that are 100% fixed income. Absolutely.
Oh, really? Okay. So you do.
Yep.
So John, you've been in this industry for a long time. So LCM Capital Management started, low cost management started in 2000. How has the industry changed the biggest from 2008 to now? What has changed in your industry with clients, with, I know you mentioned automation reduced fees, and that was amazing because when I sold Amazon at 2001 for $7, but it was actually $10, but there was $2 a share of commissions. Payne Weber, that's what it was.
At least you don't remember that, right?
I have it on my phone because if I ever get cocky about the market, I just look at that because I sold it for I think $2,800, $2,100, and I think it'd be worth $1.3 million. So I have that on my phone. That, by the way, the reason I sold it wasn't did I not believe in them or not? It was the only stock that I had left that had value. I had on sale, it was called. I had rare, medium, art, triple. My grandma gave me some this money, and I was doing amazing for a minute, and then it went up, and then I just wrote it down, and the financial advisor said, "Oh, it's a margin call. You just pay, and you just keep." Yeah. And the only thing I had value at Amazon, and so it would have been great if the guy, if I had never called him, or if I never did the if I would have just got rid of everything else, kept the Amazon, that would be $1 million, and that I would have made way more than I lost because it's crazy, this story. But anyways, I guess my question to you is what's changed 2008 now?
Yeah, well, I for sure, as you mentioned, and I alluded to fees, right? I mean, and I will back up a second because that's one thing that my partner and I said in the beginning. I mean, we were so far ahead of the curve in terms of fees and keeping them low, and so that fee compression has started and continues, and so we've never had discussions with clients about fees, and we never want to have discussion with. I mean, could we be charging more? Yeah, a lot more. And it's interesting because, our industry is consolidating. Obviously, it's a lot easier to buy than build, right? So we talk to a firm, and this firm's like, "We love your business model, but your fees are too low. You got to raise them." And you'd be surprised that people will not react negatively to that, or "Huh? You have no idea who our clients are then." Because we go to our clients and say, "Hey, we're going to bump your fee up by 30%. You'll be fine." No way, bullshit. So that's one thing that's changed for sure. Obviously, and again, bringing it back to fees, right? I mean, the mutual fund industry, the average expense ratio is dropping. Well, why that is because every fund family now has index funds. So they still have the 150 expense ratio, right? 1.5, but now they've got the index fund that's at 10 basis points. So their average now is 80 basis points, right? So that's one of the things that definitely has changed is people have realized that indexing works, and more people are going in that direction, and they are 100% correct. People are realizing that analysts and strategists don't know what they're talking about, so that's continuing to obviously enlighten people. And an education standpoint, I think people are getting more educated, and I'm not just using you guys as an example of the power of the internet and what you can help people with, because there's a lot of garbage out there too that will clog people's brains, and they won't get an honest, real opinion on what's going on. But there is definitely much more information out there, and it's not necessarily a bad thing. But I will say that, it can't be detrimental. I mean, you mentioned about, it made me think of my son, my youngest son, because I'm actually writing an article for another publication, because I responded to this guy who said, hey, how do you help young investors? So one of the things that I let all of our children do, and even young investors, is they want to play, let them play. So my boys played in this meme stuff, right? And they played in the Bitcoin, and I just kept my mouth shut. And my youngest son literally sent me a message 2 weeks ago and said, Dad, you were right. What kind of moron doesn't make money over 6 years? So he learned, and thankfully he learned now, right at 28 as opposed to 58.
But your point is he doesn't make money over 6 years, because like if you would have bought stuff, conservative assets, whatever you normally, versus what he was going for was the quick hit,
yep.
Which a lot of us, by the way, I was an idiot on something as well recently.
Yeah. Oh, and I'm still an idiot with me. I mean, I mean, literally, I'll throw $1,000 in something, like, sure, I'll play this. It's 4 cents.
I wish I only threw $1,000 in it. I bought USDC. I bought USDC Voyager, which was a stable coin, which I thought was one-to-one. So they kept talking about. It was giving a 9% yield. I should have realized when it's that high, it's too good to be true.
Yep.
So now if like T-bills are like 5% and someone says I can get you a 12%, if you say to me, John, I can get you 12% guaranteed, no risk, like 1%, I just don't believe it. Amen. Like I don't believe it now, because and to your son's point, like to your point, that is the best education. Because I thought I was smarter than everyone else. On this USDC, and I listened to it, and it's crypto, and it's, oh my God, I was on the Voyager credit committee, the chair. Like I had it was bad.
Yeah. But
that's how people learn.
Absolutely.
So it seems like you're very approachable, with people, in investments and getting, talking to clients and answering questions. I guess is the hardest thing in your industry, or is it like finding the new clients? Is it letting people know that John Nowicki exists of LCM Capital Management? Absolutely. Is that the hardest thing? I know you get referrals. I understand that, but someone told me once when I was building Benzinga, they said, Jason, if you just depend on word of mouth, we need a lot of people. You know what I mean? For maybe your industry, word of mouth is actually probably, but. So like, yeah, how, because I just think it's hard, with all these people promising, like your son's thing, the memes, get rich, I can tell you this, GameStop, see, Benzinga does the who, what, where, why, and we like say it like it is, and we have this thing, Benzinga Pro, and I started it because I thought it was unfair that Wall Street got news faster than Main Street, so we built this thing called Benzinga Pro. It's like a Bloomberg competitor, and I just thought it was unfair. Your thing is you're competing with, guys who can say anything they want, right? And it seems like you're pretty much like Honest Joe's thus far with the questions. I mean, you said the bond funds, and my ears just perked up. So I can't believe I did that. I'm in this. I'm still in it, by the way.
Yeah.
I sold like 10%. So yeah. So I guess, is that the hardest thing for you right now with the new clients?
No question about it. Right. We say we are a salmon swimming upstream, because we are definitely fighting Wall Street the whole way. And to your point, the hardest thing is, for sure, I mean, because our clients come from other firms, and the problem is what Wall Street loves to do is sell performance, right? And the reality of it is there isn't any over time. I mean, it's a factual. I mean, Warren Buffett, right? He dies. Where's all his money going, right? When he said index funds, right? The Wizard of Wall Street, or whatever the heck they call him, the Oracle of Omaha. That's where his money's going. Jack Bogle. I got a letter from Jack Bogle. I wrote an article back in '98. He responded to it. I got a call from his office. His secretary's on the phone. She said, Mr. Nowicki, I got Mr. Bogle on the phone for you. And you said I could swear. So I'm like, which one of my friends is fucking with me? I'm like, sure, put Jack through. And he goes, John, I go, Mr. Bogle? And he said, hey, I just wanted to thank you for mentioning me in your article. I'm writing another book. I just thought I'd give you a call. Happy to hear, people are thinking the same way. He sent me a letter that I still have to this day in 1998. Why I mention him is, right, always being interviewed, always talking to people, and everyone kept asking, what's an investor to do today, Jack? It was the same thing. Stay diversified, buy the index, don't time the market, don't trade the market, control your fees. When this man passed away, everyone raved about him, but I am sure, Jason, as soon as they walked out of that funeral home, they were high-fiving each other, saying, thank God he's no longer out there telling people, cut your fees, diversify, buy the index, because there's no money in it, right? And the yachting habits of our industry depend on all of these products being created. So it is the hardest thing for us to do, because even when we sit down with prospective clients and do retirement planning, we run, to your point about being conservative, I mean, we run it at a 4% rate of return, right? Let's see what your retirement looks like at 4%. We could go out there today and get that. So we're not worried about that. But at the end of the day, the reality of it is that we can for sure get that for them. I mean, without taking risk. And so if we look at that at a 4% rate of return, great. My industry runs it at 7 or 8 and gives people this feeling like, oh my God, this is something that I don't have to worry about because I'm making 7 or 8% a year. So they definitely tell people, and unfortunately show people, not a realistic rate of return. And that's why it's hard for us, because someone's in their ear telling them, I can get you 8.
Yeah, and I think, getting your name out there as much, being like even Benzinga, our reporters having you comment on something, even though it may not be just coming with that expertise or that history of, hey, in 2008, people said, because you basically this has all been trends, right? I mean, not trends, but repeats, like .com, then crypto, and then this, then that, and then AI and all this stuff, and you could come with that expertise, and that helps get your name out there for sure. Because at the end of the day, it's creating trust. And what else doesn't help you is when people who, like a Bernie Madoff, who you're supposed to trust, and then he has these results, and then it's like, okay, should I let someone, that's a challenge. But it seems like your average client, I mean, your tenure is probably a long time, I guess.
Yeah, absolutely. It's a very long time, which is great. I mean, and I think it's testament to what we do. And again, I can say just from them being educated and understanding everything, right? Because it's important. And again, people just don't know. They don't know what this impact is on fees and inflation and inflation, but taxes, and they don't understand it because it's never told them, because this is money I'm supposed to keep, right? As the house. Shh, don't talk about that stuff. Let's just focus on, look at this performance.
And do you guys have good back-end software, like show people like what their allocations are and all that?
Yep. And that's one of the great things about this industry. I mean, it really has changed, and it's made things fancier and prettier and less expensive to use, right? I mean, there's CRM softwares that people are spending gobs of money on, and you don't have to. I mean, so that's one of the great things about technology for sure, for my industry in particular.
Yep. That is for sure. I mean, the software, we use Salesforce still, but I'm like, okay, we got to move to HubSpot. It's cheaper, it's easier, and these are things. Well, I appreciate you coming on, John Nowicki of LCM Capital Management. Is there any last things you said? We got you explained how to manage money, make money. We got you to shed some tears. I always like tears. We all have our different life stories. So I like it. And I read, your bio. You are a family man. You lead with that. You have 4 kids, wife of, I said 32 years, but I don't know if that's right, but maybe it's 32. I think it was 36.
1998. So what is that? I don't even know.
Yeah. 25.
Great years, love, if you're watching. Great years.
Yeah. There you go. Well, anyways, thank you for coming on the Raz Report. You guys can Google John Nowicki, Nowicki, and look up LCM Capital Management. Been around since 2000, and they've been through the ups, downs, and seen all markets. And that's what you're looking for, someone with longevity when you're doing this kind of when you're investing in someone that knows what they've been doing for many years. So we appreciate you coming on.
Yeah, thanks for having me, Jason. Really appreciate it. And keep up the good work. What you guys are doing is awesome.
Thank you, John.